December 11th, 2008. 8:30 in the morning. A man walked into the FBI field office on Foley Square in Lower Manhattan. He was 68 years old. He wore a pressed suit. He had silver hair. He spoke calmly. He told the two agents who met him that his entire business was a lie. There were no investments. There were no returns. There was no fund. There was nothing. The agents asked him to name a number. He named one, $65 billion. The agents asked him to say it again. He did. Bernard Lawrence Madoff was arrested at 8:45 a.m. The fraud had been running for at least 17 years. Some investigators believe for 40. That is the story everyone knows. What you are about to hear is the story nobody tells. Because the story everyone knows ends with the arrest. The real story starts with the banks. Act 2, The Man in the Mirror, Code 055-230, Southo. Bernard Madoff was not a nobody. He had founded his brokerage in 1960 with $5,000 saved from working as a lifeguard. By the 1980s, he was one of the most connected men on Wall Street. He had helped build the NASDAQ exchange. He had served as its chairman 3 times. His reputation was beyond question. When sophisticated investors wanted access to his fund, they considered themselves fortunate if he accepted their money. European aristocracy invested. Charitable foundations, universities, hedge funds whose entire professional purpose was identifying fraud. They all invested. Here is the first thing to understand about what followed. The people who invested were not fools. They were the most sophisticated investors in the world. And some of them knew something was wrong. Act 3, The Analyst Who Screamed, Code 230-445. His name was Harry Markopoulos. He was a financial analyst in Boston, not famous, not powerful, not connected. What he was a mathematician. In 1999, Markopoulos sat down with Madoff's published return figures. Madoff's fund claimed to generate consistent positive returns in every market condition. Up years, down years, crashes, corrections. Every year, a gain. Markopoulos ran the numbers. He ran them again. Then he called a colleague and said 4 words. This is not possible. The mathematical signature of Madoff's returns was not the signature of legitimate trading. It was the signature of a fabrication. On May the 7th, 1999, Harry Markopoulos sent a formal complaint to the Securities and Exchange Commission. The title of the document was 23 words long. The world's largest hedge fund is a fraud. The SEC assigned it to a junior examiner. The examiner had no derivatives experience. The file was closed. Markopoulos sent the complaint again in 2001. Closed. Again in 2005. Closed. Again in 2007. Closed. 4 submissions. 8 years. 650 pages of documented evidence.
Nothing.
But here is what you need to understand. Harry Markopoulos was not the only one who knew. The banks knew. Act 4. What the banks found. Code 44570. In the 1990s, several European feeder funds approached their banking partners. Feeder funds were funds whose entire structure existed to channel investor capital into Madoff's operation. They wanted due diligence, confirmation, proof that what Madoff claimed to do was what he actually did. The banks looked. What they found was documented. The trading tickets Madoff submitted did not match the market records for the dates they were supposedly executed. The volumes he claimed to trade were in some cases larger than the total volume of the underlying market on those specific days. His auditor, the firm responsible for certifying $65 billion in assets, had 3 employees. It operated from a single room in a strip mall in Rockland County, New York. The banks wrote reports. They noted their concerns. They circulated their findings to risk committees. And then they continued. SPC continued. UBS continued. BNP Paribas continued. Banco Santander continued. Because the feeder fund fees were significant. Because recommending Madoff to clients generated revenue. Because stopping generates nothing. But we have not reached the deepest part yet. We have not yet talked about JP Morgan. Act 5. The document. Code 700-845. October 28th, 2008. JP Morgan Chase filed a document. Not with the American authorities, with the Serious Organized Crime Agency in the United Kingdom. The document was a suspicious activity report. In it, JP Morgan stated that they had concerns about Madoff's operation and that they believed it might be fraudulent. October 28th, 2008. 9 weeks before the arrest. On that same day, Madoff's account at J.P. Morgan Chase held $5.6 billion. Between October 28th and December 11th, the date he walked into the FBI office, J.P. Morgan Chase processed a further $276 million in Madoff-related transactions. They reported their suspicion to British authorities. They did not report it to American authorities. They did not freeze the account. They did not exit the relationship. They filed a document that created a legal record of their concern and continued as before. In 2014, J.P. Morgan Chase paid $2.6 billion to resolve criminal charges relating to their role in the Madoff fraud.